Welcome back. Let's dive deeper into the LIFO method. In this lesson, we shall learn what the LIFO reserve is, a phenomenon called LIFO liquidation, and we discuss the required presentation and disclosures for inventories. Let's first sum up the differences between FIFO and LIFO. Firstly, in an inflationary environment, the cost of the inventory bought first are of lower cost than those that are bought last. As such, the goods sold are of lower cost and the ending inventory are of higher cost under FIFO. Hence, the cost of goods sold in the income statement is lower, while the inventory value on the balance sheet is higher. Conversely, under LIFO, the goods sold are of higher cost and the ending inventory are of lower cost. Hence, the cost of goods sold in the income statement is higher, while the inventory value on the balance sheet is lower. All this means that the net income and income taxes reported under LIFO is lower than when it is under FIFO. Paying less taxes means that the amount of cash in the balance sheet is higher under LIFO. Because of this discrepancy, companies that report under LIFO must report a LIFO reserve. The LIFO reserve is the amount by which the LIFO inventory is less than the FIFO inventory. This value allows analysts to make financial statements prepared under LIFO comparable to those of FIFO firms. To make the adjustment, the first step the analyst has to take is to add the LIFO reserve to LIFO inventory on the balance sheet. As there is this surplus of cash from the lower taxes paid, the next step is to remove this from the cash balance. This amount is the LIFO reserve, multiplied by the tax rate. On the other side of the balance sheet, the analyst has to adjust the retained earnings to balance the accounts. This is done by increasing the retained earnings by the LIFO reserve times 1 minus the tax rate. Over at the income statement, the analyst has to adjust the cost of goods sold. To give us a clue, we need to consider the previous period's LIFO reserve. During an accounting period, the change in the cost of goods sold due to reporting in LIFO instead of FIFO is accumulated to the LIFO reserve. For example, if a company's cost of goods sold in this period is $100 under FIFO but is $105 under LIFO, $5 has to be added to the LIFO reserve. So to adjust the LIFO statement to a FIFO statement, $5 should be subtracted from the cost of goods sold. In general, the analyst should subtract the change in LIFO reserve for the period to the LIFO cost of goods sold. These are the 4 steps to convert a LIFO-based statement to a FIFO-based statement. Make sure you remember these as we go through the following example. The balance sheet and income statement of a firm that reports under LIFO is as shown. Given that the income tax rate for the firm is 40%, compute the revised ending inventory, cash balance, retained earnings, and cost of goods sold under FIFO for the year 2016. Pause the video now and work out your answers. And we're back. Let's run through the 4 adjustments that we've learnt in sequence. Firstly, the FIFO inventory is the LIFO inventory plus the LIFO reserve. Simply plug in the figures and we have an inventory value of $8,240. Next, the FIFO cash balance is the LIFO cash balance minus the cumulative taxes saved. Plug in the figures and we get a cash balance under FIFO of $3,473. The FIFO retained earnings is the LIFO retained earnings plus the cumulative earnings not reported under LIFO. This amount is the LIFO reserve multiplied by 1 minus the tax rate. Plug in the figures and we get a figure of $19,809. And finally, in the income statement, the FIFO cost of goods sold is the LIFO cost of goods sold minus the change in LIFO reserve. Plug in the figures and we get the answer of $30,455. Having the adjusted figures for inventory, cash, retained earnings and cost of goods sold, an analyst can apply these adjusted figures into the statements to get the FIFO balance sheet and FIFO income statement. With the adjusted financial statements, See if you can calculate the current ratio, inventory turnover, financial leverage, net margin, and return on equity for the firm using the FIFO method. The ratios under LIFO have already been calculated. Pause the video now to work out your answers. And we're back. The current ratio is current assets divided by current liabilities. Summing up all the current assets in 2016, we have $22,784. All the current liabilities sum up to $8,260. The ratio is therefore 2.758. Inventory turnover is the cost of goods sold divided by the average inventory. The average inventory is calculated by the sum of the beginning and ending inventories and dividing by 2. Plugging in the figures, we get an inventory turnover of 4.517. Financial leverage is the average total assets divided by the average total equity. Plugging in the figures, we get a ratio of 1.464. Net margin is the net income divided by the revenue. Plug in the figures and we get 12%. And the return on equity is the net income divided by the average total equity. Again, remember to use the average figure, which is the beginning equity plus ending equity divided by 2. The ROE is 32%. Now that we have the ratios of the firm when accounted under the FIFO method, we are able to make more accurate comparisons on the firm's ratios when compared to its peers who use the FIFO method. The current ratio is a measure of liquidity of the firm. Without adjustment, the current ratio under LIFO appears poorer than its peers. But when adjusted to the comparable ratio under FIFO, we can see that the ratio is higher than peer average. This indicates that the firm is in a better liquidity situation than its peers. Inventory turnover is an activity ratio. The adjusted inventory turnover is below the peer average. This indicates that the firm takes a longer time to sell its goods. In terms of inventory on hand, the firm has 80.8 versus the peer average of 70.2 days. Too much inventory is costly and can be an indication of obsolescence. The adjusted financial leverage ratio is also higher than that of the peers. Financial leverage is a measure of solvency, and this indicates that the firm has a higher level of debt compared to its peers. Both the net margin and return on equity are comparable to the peers. This indicates that the level of profitability is consistent with that of the industry. One shortcoming of the LIFO method is the possibility of LIFO liquidation. Under normal operations, a firm will maintain inventory at appropriate levels to sustain the business operations. When inventory is drawn down, new inventory is purchased. In an inflationary environment, the cost of inventory increases over time, and the cost of goods sold will increase accordingly. However, as you can see from this illustration, using the FIFO method can result in this situation in which over time, older and lower cost inventory are left in the account books. LIFO liquidation occurs when a firm decides not to or is unable to replenish the inventory, but instead depletes the inventory to levels such that the lower costs are recorded in cost of goods sold. In this example, the cost of goods sold for year 6 is artificially low. It does not reflect the current cost, which should be $60. This has the effect of artificially inflating the earnings for the period, as the cost does not reflect the current cost of the inventory. Such an increase in profit margin is obviously not sustainable. The firm cannot continue to sell existing inventory without replenishment. Let's end this topic with a discussion on the required presentations and disclosures for inventory items. Such disclosures may be useful to analyze a company. The required financial statement disclosures concerning inventory are the cost flow method used, whether it is LIFO, FIFO, specific identification, or weighted average cost method. The total carrying amount of inventories and the carrying amount in classifications, like raw materials, work in progress, and finished goods if appropriate to the firm. The carrying amount of inventories carried at fair value less selling costs. The cost of goods sold, which is the amount of inventories recognized as an expense during the period. The amount of write-down inventories during the period. The amount of reversal of any write-down that is recognized in the period. A discussion on circumstances or events that led to the reversal is also required. As reversal is prohibited under US GAAP, this is only applicable to firms reporting under IFRS. And the carrying amount of inventories pledged as security for liabilities. That concludes this topic on inventories. You should understand how to calculate cost of goods sold, ending inventory, and gross profit under each of the 4 cost flow methods discussed. You should also understand the effects of each method on a firm's ratios and convert statements reported under LIFO to a FIFO equivalent. In the next topic, we shall move on to long-lived assets. See you soon.